All right, so we're gonna take a look now at some of the questions that I always ask when I'm looking at a deal. What are the things that get me excited, or what are the things that can make you wanna walk away from a deal? And I would take a look at these, investing in a friend's deal. Certainly I look at them for ourselves in our own deals, and anything that we would want to put in our own portfolio. I'm looking for that right risk to reward ratio. So we'll cover all these segments, and you can basically binge watch this whole thing or break it up into smaller bite-sized pieces, but we're gonna start with the market. Really, I mean the market at large, but also the sub-market. So what's going on, in a micro level, what's happening with that specific street. In this case, my last few deals have been in Phoenix, and so I like what's going on there from an economic standpoint. Is it a business-friendly environment? Are the tenants thriving? Are the homeowners thriving? Is the population doing well? Are we kind of getting that favorable mix? Some states are not nearly as landlord-friendly as other states, so I don't love buying properties in California right now. I'm having challenges with some of my Washington properties. Arizona and Texas are places that I've invested more recently because I like the dynamic that's happening there. So after we get a good understanding of what's going on at the kind of the macro and the micro level of the market, we'll also take a close look at what's happening with the asset class. So in this case, what's happening with retail? Is there a lot of demand for it? Is there oversupply? What's happening with the tenants? Obviously, in 2020, it's been kind of a crazy situation for retail. We can expect that a lot of restaurants aren't going to make it through, and we can pivot, plan, and adjust accordingly. Those might be some of the best opportunities to pursue. Buy, vacated restaurant space, second generation space, and backfill that with a new concept. What's fun is that when we're underwriting things like market vacancy and rental rates, it's almost like insider trading. We know exactly what nearby spaces are renting for in the area. We can see exactly how much supply and demand there is, and know with a pretty small margin of error, where we're gonna land on our rents, what type of tenant incentives or improvement allowance we need to allow, and pretty accurately predict what our projections are gonna be for being able to fill up that space. We'll look at the vacancy in the area, what tenants are already nearby, who's not in the area that we might be able to backfill with, and what are gonna be the highest and best uses for vacant spaces. And so, you think about certain categories that are gonna thrive there. It could be wireless, it could be food, it could be medical. We wanna stick with stuff, especially today, that's gonna be more internet resistance, service centric. Think about things where, you're getting your nails done still, people are going out for haircuts, food might be doing more takeout, but it's still, getting picked up at a restaurant or a neighborhood basis. So all those things are interesting. We wanna have a good understanding of those going into the deal. And I just love that about real estate, is that we can really get a great understanding of all that before we ever move forward and commit any hard dollars to it. So one of the other important characteristics for commercial and especially retail is going to be understanding the traffic counts. And so most national credit name brand tenants and even mom and pops want to be where they have good traffic, good visibility, good signage, good access in and out of a building. And so we can look at that far in advance and say, hey, on Northern here, there's 32,000 cars going by every day. And the subways of the world know, down to a very thin margin of error, if there's that many cars and this many houses nearby of this certain population count, of this income, we're gonna be able to sell this many sandwiches. And so it's gotten really scientific. And we know that if there's over 30,000 cars on any given road, we're gonna be able to lease up that space pretty quickly. Conversely, if we're dealing with a property that's in a really remote location, not a lot of car count, not a lot of population density, it might be a lot harder to lease up that space or take a lot longer. It doesn't mean you can't do the deal. We just want to understand, what we're getting into and make sure that we've, allowed enough time, that we've underwritten with the right amount of tenant improvement allowance, that we're going to pay the brokers the appropriate amount of commission to get all these deals done. So the other, kind of big characteristic is understanding the demographics. With retail specifically, it tends to be a 1, 3, 5 mile radius. What is the number of people in that area? What's their demographics? What's the average household income? Because certain tenants are going to line up certain businesses with one household income, and obviously you're going to go after a different set of tenants with a different household income. And so really we can reverse engineer who it is that we're going after, again, before we ever go non-refundable on that deal, and say, hey, we've got a really good sense of who's going to go into this property, and we can specifically market for those types of users or tenants.